covering something very important, and it is called indicators. What's good, everybody? So, indicators serve three purposes. Number one, to alert. Number two, to confirm. Number three, to predict. An indicator can act as an alert to study price action a little more closely. For example, if momentum is becoming weaker, it could be a signal for a break of support. However, if momentum is rising and prices are falling, that could be a signal of positive divergence. So, indicators can be used to confirm other technical analysis tools. If there is a breakout of a price chart and a corresponding moving average crossover could serve as a confirmed breakout. So I'll explain that in the later chapters about that part. So I do use both of these methods. Divergences are to alert, and then I use moving averages to confirm. And then, yes, I do use them to predict as well. So remember, they are used to alert, confirm, and predict. They can do all three of these. So indicators are somewhat important. And no matter who you are as a trader, you will eventually have to use some type of indicator, whether it's moving averages, MACD, volume, something. I mean, you got to use something as an investor. If you're not looking at charts, you're weird, or I don't know what's going on. So anyways, you're going to hear me say period a lot throughout this chapter. If you do, it means the time frame is on. It's on the 1 minute, 5 minute, 30 minute, 1 hour, no matter what it is. If I'm saying the word period, it's for a time period. And remember, not all indicators work 100% of the time. There are some indicators that I look at each day, and I will only share with you my favorites because there are hundreds of technical indicators. Every trader has a set of indicators they find useful. It's best to start with choosing 2 to 3 indicators and learn them inside and out. So take it from me, do not clog your screen with thousands of indicators thinking you're going to hit big by using some. Indicators, making money has less to do with indicators. I'll tell you that from the get-go. It's for swinging, but as far as day trading, yes, you'll be using them for moving average bounces and stuff like that, but you don't need many indicators to succeed. Try to use indicators that serve different purposes instead of choosing indicators that move in unison. For example, it would be redundant to use the stochastics and RSI indicator because they both generate oversold and overbought signals. So I'll go over that as well. So you guys need to know this, the difference between overlays and oscillators. So overlays go on top of the price action, like Bollinger Bands, moving averages, they will be displayed on top of the price action. Like I think an overlay will also be pivot points because it's displayed right on top of the price action. And oscillators will be displayed at the bottom pretty much. The MACD, RSI, stuff like that. So that's pretty much the main difference. And then you have something called leading indicators, which are meant to lead price action. So basically, with leading indicators are designed to lead price movements. Most represent a form of price movement over a look-back period. They are most effective in trading markets and short-term holds. Many leading indicators come in form of momentum oscillators. Generally speaking, momentum measures the rate of change of a security's price. As the price of securities rise, price momentum increases. The faster the stock rises, the greater the period over period price change, the larger the increase of momentum. So basically, make a long story short, they are meant to lead price action. And the benefits and drawbacks of leading indicators, early signaling and exiting is the main benefit. For example, in an uptrend, you should be watching for overbought signals, moving average crossover, sell signals, and momentum falling. In a downtrend, you should be watching for oversold signals, moving average crossover signal, buy, momentum rising, etc. So basically, that is the benefit of leading indicators. With early signaling, it leads to higher returns. With higher returns come with the reality of reader risk. This comes with a greater chance of false signals and whipsaws. So the bad thing about leading indicators is they come with more problems, a higher chance of a failure rate. So that is why some people prefer lagging indicators, because they aren't trying to gamble too much. They're just trying to get their money, and a little bit safer. So basically, lagging indicators follow the price action and are commonly referred to trend following indicators. So what lagging indicators are, they are meant to keep you in a trend as long as possible. That is the main benefit of a lagging indicator. And then my favorite lagging indicators are moving averages and the MACD. I don't really use the Bollinger Bands that much. So benefits and drawbacks of lagging indicator. The main benefit is to catch a move and remain in the move. So that's the main benefit. The longer the trend, the fewer moves and less trading involved. The benefits of lagging indicators are lost when a stock moves in a trading range, like channels. Another drawback is that signals tend to be late. By the time a moving average crossover occurs, a significant portion of the move has already occurred. So that's another drawback. They don't really work when the market trades sideways. And on top of that, what was the other one? Oh yeah, like the signals tend to be kind of late. So that's why it's like, I don't know, like you really gotta like pick your poison with these, because there's benefits and drawbacks to both of them. You just gotta try to benefit the most. So first thing I want to go over is the simple moving average. And basically it is the average of the period that it's talking about. So if we're talking about the 50-day moving average, if we're talking about the 50-day moving average, it will be, sorry, someone told me to slow down. Just listen up. Just listen to what I'm saying. If we're talking about the 50-day moving average, it's talking about the average of the last 50 days. So if we are talking about the 5-day moving average, it will be the average of the first, second, third, fourth, and fifth day divided by 5. So it will be the average of the first 5 days. That is what a moving average is. And on the second day, see how on the second day, it will be 14, because it will be 1, 2, 3, 4, 5, all 5 of these days added up and divided by 5. So basically the simple moving average is very simple. It's the average of the days. Does everyone understand that about the simple moving average? All right. How about you, Mr. Joseph Brown? Do you understand that? There you go. So exponential moving average is a little bit more complex. You do not have to remember this right here. So you don't even have to remember this. You don't have to remember the formulas. You don't have to remember the formulas. All you have to remember is how to use them and which ones to use. Because even I don't remember this formula, and I'm not trying to remember it, because it does not matter. But what you do need to know is exponential moving averages apply more weight to recent data. So to give you guys a cheat code, you will be using the exponential moving averages to day trade, and you will be using the simple moving averages to swing trade. So what I'm saying is, on longer time frames, the simple moving average is most effective. And what I'm also saying is, on shorter time frames, exponential moving averages are better, because they apply more weight to recent data. And when you're trying to day trade, you need the most recent data in order to make money, correct? So that is why these are used for day trading purposes only, and these are used for swing trading purposes only. Does everyone understand that? All right. So let's get into a lot of examples because that's what I like to do. I know you guys are very visual learners. So by heart, the purple is the lagging indicator, aka the simple moving average, and the green is your EMA. So it's the faster moving average. So I made it green on purpose so you'll see that it's faster. So basically, to show you guys a perspective, both of these have a look back period of 9 days. So for the green one, the simple moving average is 9 days, and for the EMA, it's also 9 days. And as you can see, how is this calculated? Basically, to make a long story short, trends usually follow the 8-day moving average. So if a trend is going up nicely, it's going to follow moving average like a 9-day or 8-day moving average. But basically what this is saying is when the green crosses below the purple, you buy puts. And when the green is above the purple, you buy calls. So one more time, this is called a bear cross. And when you see the green, when you see the faster moving average cross below the slower moving average, so this is the EMA, the green, and the purple is the SMA. Green is the EMA, it's the faster one. Purple is the SMA, the slower one. And whenever that crosses below, so right here how I crossed it, you would buy puts, and then you would stay in until it crosses again. So you would kind of buy calls here theoretically, and that's why they say it has whipsaw, because you see it was a false signal. You would, but here again, a nice bullish cross, you buy calls. Now, granted, do I recommend trading with this strategy? No, but does this strategy, can it technically work? Yes. Could you technically buy and sell using this strategy? Technically, yes. And yes, you can get lucky and profit off of it, especially with stocks like Tesla. As you can see, stock like this, you could definitely do that. Yes, it's going to take some luck. Is it skill? No. But is it practical? Yes. Now, the first indicator I want to go over is the MACD, and it stands for moving average converge and diverge. So the MACD to me is the most powerful and most accurate, simple to use indicator. It gives you on point buy and sell signals, and it gives you a scope of the market. It just tells you everything you need to know about the status of whatever indicator, whatever stock you're looking at, in my opinion. That's just my opinion, especially when it comes to swing trading. So the MACD is one of the most simple and most effective indicators. It turns two moving averages into momentum oscillators. So I kind of want to just explain it instead of going death by PowerPoint. But these are the calculations for the MACD. And like I told you guys, you don't have to remember these calculations. I personally do remember the MACD calculations because I studied this indicator like it was, like it was an English paper. Like I studied it very much. And the MACD is all about converge and diverge as two moving averages. Converge occurs when the two moving averages, I don't like to read all of this because you guys won't get all of this if I read it. I'm going to kind of show you it. Because if I just sit here and read this, you guys are going to be like, so let me just show you. So let's go over. This is the part you guys want to see. Am I right or wrong? They like, yeah, you're right. Just show us the example. So let's go over it. Here is the MACD indicator, correct? This is the MACD indicator. This whole bottom row where it splits, whole entire thing is the MACD indicator. The first thing I want to go over is the fact that the shorter EMA will be my green one. So I will always make the shorter EMA a color that signals fast because it is the faster EMA, and my longer one is the 26-day EMA. So the MACD, these two lines are EMAs. They are exponential moving averages. So get that through your head. The MACD is based on exponential moving averages. This thing right here is called your histogram. It is the distance between the shorter and the longer EMA. So basically, as this moves further apart, this moves further apart too. So one more time, these little bars that you see, the histogram, is literally the distance between this. So as this is about to cross down, you see the momentum is falling on this one too. As momentum is falling on this, momentum is falling on that. And then next thing you know, red momentum, because it crossed over, the histogram will cross over red too. Whenever the MACD cross negative, the histogram will cross negative. And as it becomes further apart, as these two lines become further apart, notice how the bars get stronger. Does everyone see that? Put a yes if you want to. Okay, so you guys do understand that. And this is a sell signal. So let me show you guys what happens and how accurate the MACD is. So this is SPY, the S&P 500. This is the market you guys look at every single day and base your trades off of all the time, right? So look how positive the MACD is and how you guys could have played the MACD and got rich off of it. Like seriously, like you could literally play this on a stop and luck up, kind of, for real. So right here we see a nice bearish cross. This is so if you go straight up, you will see that the MACD cross negative right here. And if you go straight up, it signaled it right there. And then if you would have stayed in the trade until the MACD cross positive, so let's just say you would have got puts here as soon as the MACD crossed, and then you wouldn't have got out of your puts until the MACD crossed positive, and then you buy calls, right? So let's see where it crossed positive, right here. So you would have literally made money to right here, and then bought calls right here, bet on the stock market to go up, and then you wouldn't get out until about right here when it officially crossed. So let's go straight up, somewhere around this area. So look at that. You would have caught dang near a perfect move each time. So how do you avoid MACD fake outs? I would say wait until it officially crosses like that or like this. But you're going to have to give it some days because it can whipsaw. See, something like right here. Remember how it said whenever these indicators don't work when the market trades in a range? So here's a prime example of what they're talking about. See how the indicator, the MACD, becomes obsolete when it's trading in the range. But it is consistent. It is consistent because, and I've been telling people this is a powerful indicator. Like for instance, the reason I told people not to go long on SPY is because I saw a MACD bear crossover, and I know you see how this is SPY, right? I've been studying the market for 4 or 5 years just on SPY, right? So I've been studying this particular stock for 4 years. And I know based on this indicator, it is extremely correct. As you can see, it's extremely correct. It's extremely predicting the market as it should. And look right here, another buy signal. And where did it call it? Right here. And you would have stayed in that trend until about right here. Yes, the MACD to me is for swinging. Do not try this on the 5-minute chart. You will get burnt. This is only for swinging, in my opinion. You will get burnt. I've saw somebody try to trade the MACD, and it worked for like, 1 or 2 trades, and then they saw that, okay, the shorter the time frame, the more whipsaws. The longer the time frame, the more accurate, because it has more days to look back. It has more data to look back on. So, also another thing about the MACD you need to know is this line going across the entire MACD is called your zero line, right? So whenever the stock crosses below here and then it crosses above the zero line, that means strength. That means strength in the trend whenever both of these cross the zero line. So that's another thing about the MACD. It gives you, it not only tells you a signal, but then it tells you there's strength in the signal. So right about here is when it calls strength. It said, you know what, there's strength in this trend, and sure enough, there's strength. And you see here, I say right about here, it said there's strength in the downtrend, and it did go down a little bit. And that's pretty much how it judges. It's some strength right here, and look where it kept going. It didn't tell you to fall until about right here. Now, I think this is divergence right here. Bam, bam. Yep, so take a look right here, right? And you guys are going to see me explain this in the next chapter, right? Well, not the next chapter, but literally the next thing I'm going to explain. What I'm showing you guys is something called negative divergence. So notice how prices are going up, but MACD is falling down, right? We're going to get into that. So bullish divergence. What is bullish divergence? Bullish divergence is when stocks make a lower low, but MACD makes a higher low. And what does that signify? It foreshadows an uptrend. So when the stock makes a lower low, but the MACD makes a higher low, that is called bullish divergence. So let's go over it. Bullish divergence. So here, and the one thing I like about bullish divergence is it's giving you an early signal. It's giving you an early signal. So what does that do? It predicts. It's a predictive indicator, and it's very high probability. If you see bullish divergence on the MACD and the RSI, I recommend buying. So let's check it out. Here we see SQ, which is creators of a Cash App. They make a lower low, but MACD makes a higher low, and look what happened. It goes crazy, right? Does everyone understand that? Okay, so everyone understands that. And one more time, when the stock makes a lower low, but MACD makes a higher low, that is bullish divergence. So one more time, SQ makes a lower low. So the stock makes a lower low. So it went lower than the last low. So if I was to take my pen, here's a low, here's a low, here's a low, here's a low. But this low is lower than that low, right? But here's a low on the MACD because it's the lowest point. It makes a higher low. And these are literally the same lows, right? And that foreshadows an uptrend. So MACD bearish divergence, it is the complete opposite. It is when the stock makes a higher high, but MACD makes a lower high. And that foreshadows a downtrend, right? So let's get right into it. Here you have SPY, and coronavirus was first announced, as far as I can remember, around this time, right? So I'm sitting here thinking, well, when is the market going to fall? China is closing down. Nike is closing its factories. Apple is closing its factories. When is the market going to fall? Look what happens around right after New Year's. The market, everyone is so happy. Oh, the market is just flowing up. Nothing can stop it. It's in the midst of the corona. And look what happens. It falls. And look what happens. It makes bearish divergence. So the market for 2 weeks here was already pricing in a drop on the MACD indicator. So you could have caught this move before anybody. You could have looked like a genius. Everybody, I know the market is going to fall. And they're like, man, you kidding. Like, what makes you say that? And they'll have no idea. If you were to catch a bearish divergence on SPY again, you will look like a genius. Now, granted, I did catch this bearish divergence and I did play puts, but at the same time, I only caught this first gap. Like, I took profits after this big old drop. But, you know, like I said, bearish divergence is a high probability setup. And if you catch it, at least put in some money for it. You know what I mean? So here we have the RSI, which is the relative strength index. And basically, when prices, it is scaled between 70 and 30. When the indicator, so this green line is 30, and that means oversold. And this red line is 70, that means overbought. When it's oversold, it's telling you to buy. When it's overbought, it's telling you to sell. Now, anyone can tell you if they, by trying to buy off this indicator, you will lose money, because I won't say you will lose money, but you should make sure you understand the company and understand whether or not the company can bounce back from oversold conditions. If it's a good company like Disney, Apple, Microsoft, if Apple ever gets oversold, you should buy. 100% of the time, no questions asked, you should buy. Apple will not stay in oversold conditions for too long because it's Apple. Disney will not stay in oversold conditions for too long because it's Disney. Now, if you see something like Kodak, or you see something like Heinz ketchup in oversold conditions, or penny stocks, do not buy it. It may not come back because it's a shit company. Let's just be honest. To make a long story short, it's a shit company, and they may not can bounce back from an oversold condition. So that's what you need to take account of when using this indicator. Make sure you're looking at the right companies. But I will say this, you will get burnt trying to short companies in overbought conditions. You will get burnt. Do not try to short Tesla when it's overbought. Do not try to short Apple when it's overbought. You will learn. You will learn. So I already explained that part. We can kind of get into the divergences about them, but one more time, when it's over, well, this is overbought. When it reaches level 70, it's telling you to sell. Now, does it work every time? No, it does not. But I will give you guys why I believe the RSI is important and that you should use it. And you saw here when it's oversold. So I don't ever recommend shorting a company unless it has bearish divergence when it's overbought, because sometimes companies can stay. You see how it keeps trending upward, and this is just going nowhere. You don't want to ever pay attention to this. Pay attention to these. I would say do more buying than selling when it comes to this indicator, because selling doesn't work. So RSI divergences, so it's the same thing as the MACD. So that's the beauty of it. When stocks make a lower low, but the RSI makes a higher low, it foreshadows an uptrend. And here you see the same thing. So this is SPY again. It did it on the RSI as well, where it made a higher high, but it made a higher low, if that makes sense. A lower high, whatever you want to say. And what does that do? It foreshadows a downtrend whenever that happens. And then here you see some more positive divergence on the RSI. And this is the V-shaped recovery. So Trump announced a V-shaped recovery sometime around here. And I kid you not, the market did V-shape. The guy is something special, I guess. But anyways, right here you see stocks making lower lows, but the RSI is making higher lows at the same time as making lower lows, right? And that foreshadows an uptrend. And yes, that is for swings only. Now, can positive divergence happen on the 15-minute time frame, 1 hour time frame, stuff like that? Yes, it can. But if you want accuracy, I would recommend it being on the daily chart. The most accurate signal would be on the daily. Now, it can happen on a 5-minute chart, but because it's such a shorter time frame, you run the risk of more whipsaws, like I said. So the longer the time frame, the more accurate. And yes, that applies to both the MACD and RSI. Use them for swing trading purposes only, in my opinion. And yes, you can use them intraday, but you must know how. And it's really like no science to it, in my opinion. Using them intraday, they're just to confirm and predict, if that makes sense. But you really won't make money trying to trade with the MACD and RSI intraday, in my opinion. But anyways, I'm going to pass it off the mic. I hope you guys learned a lot from that lesson.
What's up, guys? Welcome to week 2, day 1. I just want to make sure everyone can hear me and everyone can see my screen before I get started. Okay, perfect. All right, today I'm going to be talking about indicators as well, the indicators that I personally use every single day when I day trade. So these are the two indicators that I use every single day, VWAP and moving averages. So VWAP, what is VWAP? VWAP means volume weighted average price, and it's an average price a stock has moved throughout the day based on both volume and price. Moving averages are trend following indicators that help determine trend direction and support/resistance levels. There are two common types of moving averages, SMA and EMA. SMA, or simple moving average, takes the mean price of a stock over a given time frame, typically weeks to months, and creates a trend line or support line a support or resistance line on the chart. EMA, or exponential moving average, is better for short time periods that takes data from more recent price action and places a directional trend line or support/resistance line. So SMA typically is used better for swinging, and EMA is typically better for day trading. So I use EMA when I'm day trading. So trading using VWAP. After a stock has created a directional trend for the day, VWAP tends to become a very strong support or resistance level. Buying calls at VWAP after a stock has created an uptrend and fallen back down to VWAP is the proper move for an uptrend VWAP bounce. Buying puts at VWAP after stock has created a downtrend and risen back up to VWAP is the proper move for a downtrend VWAP bounce. On a mid-range stock, so like, Facebook, BABA, NVIDIA, whatever, I tend to buy 20 to 30 cents above the actual VWAP line or below the VWAP line, as regularly you will see the stock bounce before it actually touches. So that line is kind of just a reference point, but a lot of the times the stock will bounce actually just a little bit before that line. On a larger stock like Tesla or Amazon, well, not so much Tesla anymore, but when it was worth, upwards of 1,000, 2,000, Amazon is still worth over 3,000. So yes, I tend to buy $1 or even $2 before the actual VWAP line. So these are my VWAP bounce trade examples, so you can see what it looks like. Apple. So like I said, when you're trading using VWAP, there has to be a trend. So you can see very clearly here, it started off kind of flat, but then it obviously made this beautiful little uptrend. It broke those pre-market highs. So then when it came back down later in the day, by the way, VWAP bounces are typically midday or later in the day. So Apple created this nice strong uptrend, and then it came back down later in the day to test that VWAP. This orange line is the VWAP line, by the way. Came back down, didn't touch it exactly. Like I said, most of the time it comes close, but doesn't actually touch it. And then it bounced off all the way from 306.50 all the way up to 310. Same thing here. So this is beyond very, very clear uptrend early on. A lot of strong buying right out of the gate. It made new highs, higher lows. So this is obviously an uptrend. And then it came down. I'm not talking about over here. I'm talking about the first time it touched that VWAP. So it touched it right at around 131, a little bit lower, around 130.70, something like that. Touched it and then bounced it all the way up to 133. So like I said, it creates a trend, and then later in the day, typically midday or even like 1 p.m., 2 p.m., comes back down to test that VWAP line and then bounces off or rejects it. Same thing here, CAT. So this is a clear uptrend, right? Makes higher highs, broke the pre-market highs, makes higher highs, higher lows, kept making new highs. So that's obviously an uptrend. Then it came back down, didn't touch it exactly. This is the orange VWAP line. But you can see if you're looking at the price scale on the right, it came about 20 cents away from it. So that's why I say, I typically like to buy 20, 30, even 40, 50 cents away from that line, because sometimes it doesn't touch the exact line. So it came down about 20 cents away, and then that's when it bounced off. Disney. So this is when you can't trade using this strategy. You can't trade using VWAP if there is no clear trend. So that's the most important factor when you're looking at VWAP bounces, is there has to be a clear trend. So in this chart, it's very obvious. You can see in Disney, there's just no clear trend. It started off down and then came all the way back up, made like a V-shaped recovery, and then, faded back down, came back up. So there was no clear trend. Obvious, just looking at this chart, there was no clear uptrend. There was no clear downtrend. So you can't use VWAP to trade because it just kind of like floats back and forth off of it if there is no clear trend. And then Netflix. So this is an early morning strong trend. You can play the VWAP bounce from the morning, but you can see here it actually bounced off of it multiple times throughout the days. So VWAP definitely acts as a strong support or resistance if there is a strong trend. So in this, you can see very clearly from the bell, these candles, these 5-minute candles are huge. So there's a lot of buying pressure. So when it came up and made these new highs, it bounced off it, once in the morning, and then again a little bit later, midday, it bounced off it actually 3 times right there. And then it bounced off it again, starting in the afternoon. So you can actually use VWAP as a support or resistance if you have a clear trend like this. And then NVIDIA, this is an example of how sometimes it just doesn't work. No trading strategy is 100% accurate. We obviously got this strong uptrend in the morning. It broke those pre-market highs and made newer highs, and then it started fading off. It was coming down. It tapped that VWAP, and then it just didn't bounce off of it. So how would you know when to stop loss? Well, if one of these 5-minute candles closes below, and it just obviously is not bouncing. So in this example, it's just clearly not bouncing at that VWAP. So you want to make sure that if you're doing the strategy, that you get some sort of buying pressure when it, a little bit before that orange line, and then especially if it actually gets to the orange line. PG, this is another beautiful example. I mean, very clear, strong uptrend all morning. I mean, it rode all the way up for like almost 2 hours. And then it finally started trickling back down. And that's when you're going to use the strategy. So it came down, touched that orange VWAP line, and bounced off of it beautifully. Shop, same thing here. Early morning strong uptrend, early morning VWAP bounce. So in this scenario, this you could have easily gotten stopped out of this. So I did want to show it's not always 100%. Like I said, it did come down. But if you saw these two candles right here, these two red 5-minute candles, that shows kind of strong selling. So you want to make sure that you're not jumping into this position until you start to see, that bounce there. It did bounce off of it like $4, even a little bit more, $5. But that is what I'm showing you here. Tesla, super beautiful VWAP bounce here. You got that very strong upward momentum in the morning. It broke those pre-market highs. These 5-minute candles are huge and they're beautiful. So when it came back down, just like an hour and a half after the open, it hit that orange VWAP line and bounced off of it like almost $20. So beautiful Tesla VWAP bounce there. So key takeaways for trading VWAP. The most important aspect is there has to be a trend established, whether it's to the upside or downside. On a mid-range stock, $100 to $300 typically, plan to buy 20 to 30 cents above the actual VWAP line. Or if it's a downtrend, you'll short 20 to 30 cents below that line. On a larger price stock, so like $500 to $3,000, plan to buy anywhere from 50 cents to $2 above the actual VWAP line. And remember, the strategy is not 100%. Be prepared to stop loss if the stock doesn't bounce at VWAP. Most importantly, make sure there is a clear trend on the stock before buying or shorting the bounce. That's the most important part. So in order for a stock to bounce at VWAP, it has to have an average volume and price. So you have to make sure there's a clear trend on the stock before buying or shorting the bounce. Now, trading using moving averages. Use exponential moving averages if you are going to be primarily day trading. Use simple moving averages if you are going to be primarily swing trading. Likewise to VWAP, you have to make sure a trend has been established before entering using moving averages. My favorite combination of moving averages for day trading is the 8 EMA and the 21 EMA. Algos tend to have preset bids / asks or buys and sells sitting at those moving averages. So if there's a clear trend for the day, you can expect to bounce from those trend lines 90% of the time. Using the 8 EMA in day trading. So same thing, you want to make sure that an uptrend or a downtrend has been established, but in this scenario, I'm looking at an uptrend. So I'm looking here, Apple created an uptrend, it kept making new highs, it broke those pre-market highs. So I'm looking when Apple touches that 8 EMA, which is this purple line, and I'll show you guys how to put those indicators in TradingView. But the 8 EMA is this purple line. So how do you trade using moving averages? You wait until it gets that purple line, which is the 8 EMA, and then you'll buy calls or you'll long the stock when it gets there, and then it bounces off. So that's how you trade using moving averages, and that's how you trade using VWAP. You're not waiting for breakouts of anything. You're just playing bounces. AMD, beautiful uptrend created here. Kept making higher highs, and that's the most important part of an uptrend or a downtrend. You want to make sure it's either creating higher highs or it's creating lower lows. So AMD, the uptrend was established. It came down to that purple line and it bounced. So it actually broke that purple line, but if you look at the price scale, it only broke it by about 5 cents. So you want to make sure that you can still do the strategy as long as it doesn't really break it. It never broke below this pre-market high. It never broke below this previous high down here. So, that's fine. It can break that moving average just a little bit. There's no problem at all with that. and then you'll just either buy calls or you'll long the stock when it gets that purple line. So in this scenario, you would have longed it around 52.83, something like that, and then it bounced up perfectly right off of that. Here you go. Here's another one. So Amazon, it started off down a little, but then it had a lot of strong momentum, made new highs, it pulled back a little bit, made new highs, broke pre-market highs. So then when it gets down to that 80 EMA, that's when you're going to buy calls, you're going to long the stock. So it came back down right to 23.78, you can see on the price scale, and then it bounced all the way up to about 23.85. So that's a $7 move. Now, you're not looking for anything crazy on these bounces, but it's easy money because you're just buying at the bounce. You don't have to wait for anything. You don't have to wait for volume. You're not watching for a breakout. You're simply, if there's an uptrend or there's a downtrend, you're going to buy when it gets to that 8 EMA line. Beyond, same thing. So it broke pre-market highs, a lot of strong momentum off the bell. These 5-minute candles are beautiful. They're huge and they're full. Made a little pullback here, but it broke through that again. So when it gets to that 80 EMA, very simple, you're going to buy calls. You're going to long the stock. And you're just going to take a bounce. So, the 80 EMA was about 129.50. So you would just take this long, or you would buy calls. And then as soon as you make money, you start selling off your contracts. You start selling off your shares, whatever you're trading. And you can see this bounce went all the way up to 132. So that's a $2.50 move just on a bounce. Netflix. So, same thing here. Huge, beautiful green 5-minute candles. Kept making higher highs, broke the pre-market highs. So when it gets down to that 80 EMA, there you go. You just take it long, you buy calls, and you take that beautiful bounce. So that, it was about 439.25, and it bounced all the way up to 442. There's nothing complicated about trading the 80 EMA. You're simply, waiting for an uptrend or downtrend, and then you're going to buy calls when it gets to 80 EMA on an uptrend, or you'll buy puts when it gets to 80 EMA on a downtrend. Roku, like I said, no strategy is 100%. So this is an example of how it doesn't always work out. So these candles are beautiful on Roku. I mean, this shows a lot of buying until it gets up here. This candle is super bearish. It's a bearish pen bar actually, and then it came down. It looked like an uptrend was starting to form. It came down, touched that purple line. It did bounce a little bit, about 75 cents, but then it just came back down and kind of flushed that line. So in this scenario, you're going to want to stop loss when that 5-minute candle closes below and it's just not showing any signs of recovery. Now I also use the 21 EMA, and this is a more gradual strategy, but this is how I use it. So you want to make sure, same thing, uptrend or downtrend is formed, but now the 21 is a little bit shallower. So the 80 EMA is very steep, right? It's very close to the candles. The 21 is a little further away, and typically the candles will start bouncing off of it later in the day. So this example, very clear uptrend was established on Beyond. So you wait until it gets to that 21, and then boom, that's when you're going to long or you're going to buy calls. So it gets to 21, you're in. And it bounced off it perfectly in this example. Here we go, same thing. Uptrend established, 21 EMA bounce. So we got to that 21. This is probably around like noon, and then bounce straight off of that. So like I said, 21 is more gradual. It's a little shallower, so it typically won't hit that line until around midday or even in the afternoon. Here you go. This is an afternoon bounce. So Lulu, was riding this uptrend all morning. Finally, around like 2 p.m., it hits that 21, and that's when it bounces off of it. 21 bounce here again. This is around noon. So beautiful. Remember, I showed you the same example, but for the 8 EMA. It was right. The 8 EMA was riding these candles very, very closely. So you're going to want to use that 8 EMA when you have a strong uptrend or a strong downtrend. The 21 EMA is a little more gradual, right? So it tends to happen midday or later in the day. And that's when you're going to take the bounces for the 21. So in this Netflix example, it created this strong uptrend established. And then around noon came down to touch the 21. And that's when you're going to buy calls or long the stock. There you get that bounce. Beautiful. NVIDIA, same thing. Created an uptrend. I showed you that the ADMA was around here, so in the morning, but then the 21, like I said, is more gradual, so it came back down. This is around noon again. So it came back down, hit the 21 around noon, bounced off of it perfectly. Tesla, I showed this example on VWAP, and it actually hit at the same zone, which I'll be showing you what that means when VWAP and the 21 EMA hit on the same zone. It's very important, but you can see very clearly had this beautiful uptrend, and then around 11:45 here, it hit that 21 EMA and bounced off of it beautifully. It also came back down in the afternoon, hit that 21 EMA again, bounced off it beautifully. So using a combination of 821 and VWAP, I'm going to show you guys the secret in a second, which is how you can use VWAP and a combination of the moving averages. But this is what it looks like all together. So it's not super confusing. It's not crowded. Your charts don't look very crowded. It's just 3 lines. The one that's the most gradual is always going to be VWAP, and then a little less gradual is the 21. And then the one that's hugging the candles is going to be the 8 EMA, the purple line. Tesla. So I'm about to show you guys this trick, but look at this. So VWAP, which is the more gradual one here, and then the 21 EMA, which is slightly less gradual, they both converge right here. So they touch, and Tesla bounces off of it very, very hard. Very hard. So when the 21 EMA and VWAP align at the same price point, there's a very high probability chance that the stock will bounce off of that convergence. So key takeaways for trading moving averages. Ensure a trend is established. Use EMA for day trading and SMA for swing trading. Think of moving averages as accuracy based on time. Lower time spans work best for smaller length moving averages. Use the ADMA bounce within the first 2 hours of the day or after a very strong momentum trend. Use the 21 EMA bounce within the first 3 to 5 hours of the day or after a gradual uptrend or downtrend. If you have the capital, you can use a combination of ADMA, 21 EMA, and VWAP to average into positions and avoid potentially getting stopped out. So I want to show you guys now with a drawing how to think of moving averages is accuracy based on time. Let me see. Can you guys see? Make sure. All right, here we go. So I'm going to show you guys what exactly I mean. One sec. Someone comment if you can see the drawing tool. Let's see. Trying to draw, it's not letting me. There we go. All right. So I want to show you guys exactly what I mean when I'm saying moving averages are accurate based on time. So let's say you're using the 8 EMA, then you want to make sure you either have a strong uptrend or a strong downtrend. What I mean by strong is simply steep. So if the trend is very steep, if the uptrend is very steep, then you're going to want to use the 8 EMA. If the downtrend is very steep, like literally an angle, then you want to use the 8 EMA versus the 21 EMA, kind of a gradual trend, gradual uptrend or gradual downtrend, not so steep, kind of more relaxed. That's when you're going to want to use the 21 EMA or VWAP. All right, sorry that my writing is terrible, but I hope that makes sense. So if you have a steep uptrend or downtrend, 8 EMA, a gradual uptrend or downtrend, 21 EMA. And then remember, this is my bonus tip for you guys. Oh, maybe I should clear that. Anyway, clear. All right, bonus tip, if both a key moving average and VWAP intersect or are at the same level, that level is huge support or resistance and has a 95% chance of bouncing. So here I say Tesla in last slide is perfect example. So you can see here, Tesla in the last slide, VWAP, which is the lower line, and the 21 EMA, which is the more gradual line, they both intersected in the morning at the same price point. So they both intersected at around 807. And you can see the stock got to that level, Tesla, and just rocketed off of it. So it rocketed off of it almost $20 because that is such a strong support. And if it was a downtrend, then that would be such a strong resistance. So if both a key moving average and VWAP intersect or at the same price level, that level is huge support or resistance and has a 95% chance of bouncing. So those are all the indicators that I use. I like to keep it simple, but I use VWAP and I use moving averages every single day. The most important part about using both of them is that there is a clear trend. Anyway, hope that made sense. I'm going to pass it off to Unraveler now.
Thanks, Mike. Hello, everyone. Hope you guys can see my screen and having a great weekend. Welcome to day 4 of AMU University. So today I'm going to be teaching you about momentum trading using Wyckoff method. And I'm also going to go over a couple of indicators that I use for my swing trading. One of them is accumulation and distribution. Another one is OBV, which is the on-balance volume indicator. So let's get started. So the table of content for today's lesson. First, I'm going to be going over basically reviewing a little bit of what we discussed in our last class, trading using momentum, that is identifying momentum stocks before they break out. Remember that we went over 2 different strategies. One is basically trading price action momentum. And I also gave you an introduction on the other strategy, that is trading momentum stocks before the breakout happens. So that's what we're going to be discussing today. So one of the most I use this strategy a lot for swing trading, and it's helped me make a lot of money, and hope you guys can learn from this and make money on your own as well. So anyway, let's get started. So the second topic that I'm going to cover is Wyckoff method. So this is a market theory. It's very popular among institutions and big funds. They follow this. A lot of traders and hedge funds, they are practitioners of certain types of methods. So some of them would be Elliott wave theory traders. Some of them may be Wyckoff traders. Some of them may trade just based on Fibonacci levels. There are a lot of different types of traders in several banks and funds. And Wyckoff method is one of the popular traders because a lot of those big monies and smart traders, they don't day trade primarily. They take positions in one of the companies. They buy low and they try to accumulate a lot of shares in that position, and they try to ride the trend and take profits. So that's how big money trades. And the Wyckoff method is going to be useful for you. And it's one of the most important theories that I use for my swing trading strategies. Anyway, so once we cover Wyckoff method, I'll be going over the accumulation and distribution indicator, which is how we're going to implement the Wyckoff method. And so then I'll be showing you guys how to calculate the AD, uses of AD, the differences between AD and OBV, disadvantages of AD, and lastly, I'll be going over a couple of real life trade examples. Okay, hope you guys enjoyed this lesson. Please feel free to take screenshots and notes. It's going to be a little long and it's not going to be that straightforward, but hope you guys understand this and try to follow along. Okay, let's get started. All right, trading using momentum. The goal of momentum strategy is to buy when there's strong momentum and sell when the momentum begins to show weakness. So we discussed this concept in our last class, and we discussed about price action trading, and we learned about the characteristics of strong momentum stocks. We learned about the characteristics of weak momentum stocks. So we know when we look at a chart, we know when there's strong momentum. So when you see good candlesticks, when you see the range of the candlesticks like increasing over time, that's strong momentum. And when you see the range of candlesticks contracting, and when you see a lot of indecisiveness, and you see a lot of the range shrinking and volume declining, that shows weakness, and that's when you either take profit or trim your positions. So there are two approaches to momentum trading. Wait for the momentum and price action to be confirmed before entering the trade. This is what we discussed in our last class. So this is our day trading strategy. We look for good pre-market movers, and based on the open, we'll enter trades which are showing good momentum and volume, and we'll ride the trend and take profit when the trend becomes weak. So there's another strategy that we didn't cover exactly in our last class. So that is to enter the trade before the momentum starts to rise. So this is typically how, like I said, institutions trade, and as swing traders, you want to get in to ride the whole move. And you're typically looking to ride a move that lasts for a day or maybe even a couple of days to weeks, and you will just accumulate positions and ride the trend and take profit when your profit target is reached. So this approach allows traders to ride the momo, that is momentum from start to finish, without missing any part of the move. So however, the traders employing the strategy must read price action very carefully, develop a sound game plan assessing both risk and reward before entering the trade. Obviously, this method is a little bit risky compared to day trading, because you're taking position in a stock, you're anticipating a move, and like things goes, 9 times out of 10, your move may hit, but there is still that chance that 1% that your trade may not hit, and it may go against you. So there's a lot of risk involved in the strategy, but if you get it right, it's worth the risk. You're actually making a small bet, and you're reaping rewards, to a larger extent. The key to this approach is identifying the stocks before the momentum starts to rise. That's easier said than done, but we're going to see a couple of strategies. And the strategy that I'm going to teach you today, is something that I use and I've been using for a couple of years. I've perfected it right now. Still looking for kind of stocks still looking for stocks that fit the criteria. In this current market, it's a little hard, but we did a couple of plays 2 weeks back using this exact strategy. I've added that particular trade to this PowerPoint. So hopefully, if you're in Aristotle's chat, you would have caught that move as well. Okay, now let's get started. Wyckoff theory. Richard D. Wyckoff was an early 20th century pioneer in the technical approaches to studying the stock market. He is considered one of the 5 titans of technical analysis, along with Dow, Gann, Elliott, and Merrill. Through his years of research and experience, Wyckoff observed that most retail traders repeatedly get fleeced by institutional players. To overcome this system, Wyckoff learned how to identify institutional accumulation and distribution of stocks. So Wyckoff, if you've never heard of Wyckoff, Wyckoff is one of the technical analysis pioneers. He's a genius in the stock market. He's published a lot of papers on technical analysis, and if you pick any technical analysis book, you would find the names Dow, Gann, Elliott, and Merrill, along with Wyckoff in there. And what Wyckoff theory specifically talks about is Wyckoff had a frustration with the market in general. So through his years of experience, he's observed a lot of retail traders like you and me, repeatedly get fleeced by institutional players. That is the smart money, the hedge funds, the millionaire and billionaire class. So what he basically observed was that the millionaire and billionaire class and the smart money, they had the information edge, meaning they get the information beforehand. They know how the stock is going to move. reacting to news, reacting to catalysts before anyone else in the market. So they end up taking positions that's favoring them. So for example, if there's some kind of good news going to come in, they'll probably already have a large position in the stock. And when the move eventually hits, they're going to make a lot of profits. And similarly, if some bad news is going to hit, let's say the market is going to crash or something, 9 times out of 10, these smart money, they would have already hedged up, or they would have taken profit, and they would get the news beforehand. And so, like the retail traders would not. So retail traders always end up getting the short end of the stick. And Wyckoff, he wanted to somehow find a way to make sure that retail traders were also able to keep up with the institutions and make money in the stock market. So to overcome the system, Wyckoff learned how to identify institutional accumulation and distribution of stocks. So what does that mean? Institutional accumulation and distribution of stocks. Accumulation stands for buying, distribution stands for selling. And Wyckoff learned, he created a system where he could identify institutional buying and selling of stocks. So why did he want to do that? He strongly believed that retail traders needed to think like the institutions and take positions in harmony with the smart money to be successful. So obviously, we know that we don't need to reinvent the wheel here. We know that the smart money is already making a killing in the market. So what Wyckoff thought was that if he could somehow identify some kind of a system where he could, find out what the smart money is doing, he could basically let the retail traders could basically just follow the same process and take positions in harmony with the smart money to be successful. There's no need to reinvent the wheel. There's already a winning formula here. So just need to follow that formula to be successful. So that's Wyckoff's whole concept. So this theory that we're going to discuss is basically taking positions in harmony with the smart money, anticipating a breakout or a big distribution sell-off, and then making profit off of that move. Okay. So that in a nutshell, that's Wyckoff theory. Now let's go deep. Let's deep dive into this theory so that we understand the nitty-gritty details. Okay. So this is Wyckoff's market structure. So the Wyckoff's theory states that the price cycle of a traded instrument, that is a stock, consists of 4 stages. So when I say traded instrument, it's basically any stock in the stock market. So if we take any stock, let's say Apple, Facebook, Nvidia, Google, anything out there. If you open a chart, let's say the 4-hour or daily time frame, the stock's going to fall in the stock, wherever the stock currently trading at, it's going to fall under one of these 4 phases. So we're going to learn what these 4 phases are so that you understand the rationale behind this theory. So when I talk about swing trading, it's more about how you read the market. So if we don't have a good understanding of the market, you'll never be able to take those long positions in the market. On a day trading, you're looking at smaller time frames. You have confirmation, you trade like that. But when you're actually taking positions, or like you're holding positions overnight, you don't want to be get caught off guard. So you want to know what's exactly happening in the market and take positions in harmony. So the entire market selling off, no matter how good of a setup it is, if you buy calls or buy stocks, chances are you're not going to make money in the short-term time period. But that's why it's important to know what's exactly happening in the market. And we're going to learn about those 4 phases today so that when we talk about the indicators, that's later on in this lesson today, you understand what exactly we're trying to achieve using those indicators. Okay. Anyway, let's get started. So the first phase is accumulation phase. In this phase, there's high supply with low demand due to a bear market or recently strong decline. Due to the recent strong decline, the average retail investor is too scared to own shares due to fear of further downside. So usually when a stock sells off as hard as it does, okay, there is fear in the market. So recently stocks were just rallying for the past couple of months, 3, 4, 5 months, ever since March or April. And suddenly we had 2 or 3 days of a correction and everyone's scared to buy stocks because every time they buy stocks, they just keep selling. A lot of people lost money these past couple of days because everyone thought that just buy the dip. When you buy the dip and it keeps dipping, it's going to hurt your account. So instead of reading the proper trend, a lot of people kept dip buying and they got crushed. So when something like that happens, when a stock sells off, okay, fear is at all-time highs. And that's when there'll be high supply in the stock, meaning everyone will want to sell the stock because there's fear. So when there's high supply and low demand, meaning when everyone wants to sell, demand is going to plummet. There's a strong fear in the market, and due to the fear in the market, the average retail investor is too scared to own that share because he or she fears more downside. So usually when a stock sells, the seller is always going to think that it's going to keep selling, so I'm actually cutting my losses here. So the chances are he is right, but more than 9 times out of 10, that's not exactly true. What's going to happen is probably the stock's going to bottom out somewhere, and it's going to like continue rallying after that. So accumulation phase is when smart money enters the market. It is characterized by a ranging market structure. So after a big sell-off, the stock's going to start, the stock that we're talking about is going to start arranging market structure. Stocks don't keep always going out. At some point, the selling is going to climax. What does mean is, since the people that are selling already sold off, and the supply starts to dry off, the stock market is going to form a range-like structure. So we already discussed what a range-like structure is like in our trend lesson. And so essentially it's characterized by there are no new higher highs or higher lows formed. It's just a ranging structure characterized by low volume, and the stock just continues to trade in range. And this ranging market structure is what we call as accumulation phase. So Wyckoff believed that traders needed to follow institution and enter the market in accumulation phase while the stock is still trading in range to maximize returns. So remember a couple of lessons back, I told you that it's very risky to enter a market when there's accumulation phase, meaning when the market is trading sideways. That is true. That is still true. And you need to be very careful when you're entering the accumulation phase because you don't know if it's an accumulation phase. All you can see is that the market is trading sideways. You have no way of knowing that which direction this is actually going to break. It can break to the upside, but at the same time, it can actually distribute and break to the downside as well. So that's why it's very important to actually know whether the stock is accumulating or it's distributing. Both the accumulation and distribution phase that you see here is characterized by a flat ranging market structure. So it's important to know whether the stock is accumulating here or the stock is distributing here, meaning is smart money actually buying the stock here? Are they actually buying cheap shares in anticipation of a big move? Or are they just, or is the market just consolidating to sell off even more? So that usually happens. We all know that the break of the range can happen in either direction. Okay, so I'm going to teach you how to identify accumulation later on. But essentially, this is where the smart money enters the play. Uh, when everyone's selling their shares due to fear, smart money is actually the ones accumulating those shares because they know that this selling is not going to last, and they're trying to accumulate cheap shares when the supply is very high, and when the move eventually happens, they'll be the ones to capitalize on it and make a lot of money in the market. Okay, so Wyckoff emphasized that this approach required meticulous study of price action and volume and stressed the importance of timing, both entry and exits. Now, timing is a very important thing. We may be getting, let's say, once the sell-off happens, we may start accumulating shares, but we have no way of predicting when exactly the break of the range is going to happen. So, especially when we're option trading, remember, we have an expiration date tied to our option contract. So we need to time our entry and exits well, and I'll teach you how to do that. And the Wyckoff emphasized that this approach is required meticulous study of price action, meaning we need to know exactly study what's happening in the market and study volume, and then time our entry and exits correctly to capitalize on this process. Okay. So the first phase, I hope I just want to recap here. Accumulation phase is the phase where which actually comes right after a big sell-off. And this is the phase where smart money accumulates shares in the market. They are accumulating shares because they think that the stock is going to go higher in the near future. And what Wyckoff suggested that for retail traders to actually to take positions in harmony with the smart money, they will have to enter the market in the accumulation phase. That is before the big breakout happens to maximize returns. Okay, so that's the first phase, accumulation phase. Hope you guys understood that. Now, phase number 2 is markup phase. So this is the phase that follows the accumulation phase. So in this phase occurs when supply of an asset has been diminished due to accumulation of shares by smart money. The demand picks up when retail investors start taking notice of the upside potential of the underlying asset. This may be due to a news catalyst triggering the move. Now, soon, so smart money is accumulating shares, and like I said, selling does not always continue. This stocks just don't keep selling off. At some point, it's going to be oversold, and people are going to buy in, accumulate shares. And at some point, supply is going to diminish, meaning there are no more people selling. So when supply is like diminished, demand starts to pick up when there is some kind of news catalyst. So in this case, what happens is, since smart money is already accumulated shares, somewhere out of nowhere, like chances are these things play out always like this. You would just have some kind of good news come out. For example, let's say some stock is trading sideways. Let's say that it's Beyond Meat or whatever it is. Somewhere out of nowhere, you'd see that good news come out, and the stock just continues a new uptrend. So you may think that this is coincidence as a retail investor, but as smart money, I'm watching the market for time and time again. You see these things happening all the time. The stock's been selling off, suddenly you get this good news and the stock starts rallying. So if you study be in the market long enough, you know that there's some kind of thing happening in the behind the scenes. And in this case, smart money has already accumulated shares, and by the time the good news or catalyst or the new upside potential, maybe it may be due to an analyst upgrade or downgrade or a new price target or some kind of new like a theory some analyst published. So whatever the case may be, suddenly the market will realize that there's good upside potential in the stock, and that causes demand to go up even more. When demand goes up more, the stock prices is going to go up. And what happens here is, in the markup phase, where the stock is going to break this range to the upside, and it's going to start a new uptrend or rally. Okay. So this increase in demand causes the stock price to break out of range, thereby initiating a new bullish trend or rally. And you can clearly see that smart money who accumulated shares here, they're just going to ride the trend here. And as the news keeps coming, as good news keeps coming out, the demand is going to skyrocket. And all these places where you see out here, these blue points, is where most retail traders are going to jump in. Everyone sees the stock rallying, more volume is going to come in, and stock's going to keep pushing higher. Okay, so that's markup phase. Markup phase is the rally that follows the accumulation phase. And this is the phase where we would capitalize as well. So we've already taken positions here in the accumulation phase. So we'll be riding the trend and eventually be taking profit somewhere around here. So the third phase is distribution phase. Like the name implies, distribution stands for selling. So during this phase, the demand stays the same, meaning so because of this new uptrend, let's say the stock rallied 20% from its accumulation area. So people are going to look at this stock bullish. People are going to think, wow, this stock's rallying. This is the hot stock in the stock market. It's just unstoppable. Everyone wants it. That's the news that you're going to read as a retail trader. So the demand still stays the same while the supply increases, meaning the demand stays the same, but the supply increases. What does that mean? It means that smart money starts distributing shares to their retail investors. Remember, smart money is just not going to keep bag holding all the time. They want to make money, and they actually want to secure profits. So they accumulated a lot of shares here. So they're going to start distributing their shares slowly. So as smart money exit their positions, retail traders still continue to buy at the top here because they think that the demand is still the same. The stock's just going to consolidate and going to keep going up. Chances are that can happen, but knowing this theory, that never happens. I'll show you examples later on. Okay. All right. So like accumulation phase, distribution phase is characterized by a ranging market. So remember, I told you that accumulation phase looks like a ranging market structure. Distribution phase also looks like a ranging market. You'll see those low volumes. You'll see those periods of consolidation. Now, if you're an intraday trader, short-term trader, you may just look at this some kind of like a bull flag. Chances are that may be the case. So if this is a bull flag here, the chances are we consolidate here and this breaks this bull flag, it can rally again. But you need to read whether it's an accumulation or distribution phase, and that's what our indicator is going to help us. So if this is a secondary accumulation phase, chances are we're going to see another breakout happening here. But if it's a distribution phase, chances are we're going to consolidate and then we're going to like sell off. And in this phase, demand stays the same, supply increases because smart money starts distributing the shares to retail investors. Like accumulation phase, the distribution phase is characterized by a ranging market, and price fails to break out of this range to the upside several times. So that's another key factor that you can always observe. So when we're trading in this ranging market structure, the distribution phase, price actually will try to break out of this range several times. But every time it tries to do so, you will notice that there'll be a hard sell-off. So, and another thing that you can observe is all rally attempts occur on low volume, whereas pullbacks occur on strong volume. So every time it tries to break this range, that will be on low volume. But every time it pulls back, you see these red bars here, that shows that the selling volume is high. So that's another characteristic of a distribution phase. You'll see low buy volume, you'll see high sell volume, and you'll see price fail to break out of this range to the upside several times. So those are the cues apart from our distribution indicator that this is actually a distribution phase and not accumulation phase. In the accumulation phase, what will happen is every time it sells off, it will be on low volume and every dip gets bought. So that's the difference between accumulation and distribution phase. Okay. Okay, so I hope this is clear. Now let's go to the last phase, that is the markdown phase. So during the markdown phase, supply is at an all-time high, meaning that sellers outweigh the buyers. Remember, what did I tell about selling? So when fear is at all-time highs, you see a lot of people wanting to just get out. Everyone will be emotional when they see red. So when we see selling, that's why selling just keeps on accelerating. But that's why if you're a trader like me that likes to play at the downside, you will make a lot more money than a lot quicker money than if you're playing the upside. Stocks go up, but at some point they lose their momentum. But on the downside, fear is also an important player. So you'll tend to make a lot of quick money playing the downside. So the markdown phase is confirmed when price action breaks the lower end of the range, confirming the start of a downtrend or bear market or correction. So whatever it is, depending on the size of the move. By the time the markdown happens, smart money would have already secured profits from their long position. Remember when we discussed this, smart money already started selling their positions right here after taking the position in accumulation phase. The distribution phase, they've already started taking profits here. And retail traders keep buying this phase here, thinking the stock's going to break higher, even more higher. And when the support breaks, everyone panics. So most retail traders that bought the dip here, bought the top here, they're going to just sell off because they're not strong money. Since we don't have institutions taking part in this rally over here, we're not going to have when the price is not going to hold once the support breaks, and that's when you see strong selling. This strong selling is what we called as markdown phase, and at the end of the markdown phase, eventually the selling slows down and the stock starts to find some support and the accumulation phase starts all over again. So once the stocks actually find some bottom here, once the selling cools off, remember fear is at high again here, and eventually there'll be a bottom. That's when we'll start another accumulation phase. Okay, so that's how Wyckoff classified the market, as he classified them in 4 phases: accumulation phase, markup phase, distribution phase, and markdown phase. So any stock chart that you look at is going to be in one of these 4 phases. And as a trader, if you know how to read this market structure, you have a lot of trading opportunities here. Not only can you long the stock during accumulation phase, you can actually ride the trend. You can actually participate in the distribution phase, that is, add more short positions here, and then ride the downtrend. As long as you know how to read this kind of chart, know this. So whenever you look at a stock chart, you need to think in terms of the 4 phases. What is the stock actually doing? We know that all of us can read uptrends and downtrends by now, but what is exactly happening here? What is the smart money doing? Is this just like trading in range because it's going to go, the market is expecting a big move, or are we just trading in range because the market's going to expect a big downturn? Because these are the things that you can interpret from Wyckoff's logic. It's a very nice theory. I've covered the basics of it, but if you're an actual Wyckoff practitioner, there are a lot of phases that actually form within. So there is a selling climax, there is a spring, there is a test. There are a lot of smaller phases that happen within each of these phases that you can understand. But as a positional trader, you just need to know how to read this. And as a swing trader that I'm going to teach you, if you can identify when the stock is accumulating and when the stock is distributing, you would be able to take good swing trades and make money off of this process. Okay, I hope that this theory is clear. I just wanted to give you guys the rationale and the thought process behind this swing trading strategy. Okay, I'm going to cover the details and the indicator right now. Hope you guys enjoyed the first part. So second part here is the accumulation distribution indicator. So this is one of those indicators that I use to capitalize on the Wyckoff's theory. I know how the Wyckoff's theory works, but I need an indicator to help me actually identify the accumulation and distribution in stocks, because I can say accumulation and distribution, but there's no way for me to know when it's happening without the use of some kind of tool. And that's where this indicator comes into play. Uh, so for day trading, I use all the indicators that Mike and Aristotle use. But for swing trading, this is one of those indicators that I like to rely on, especially when I'm looking for a Wyckoff play. So what I mean by Wyckoff play is not all stocks, all swing trading setups that I take is going to be based on Wyckoff, but the ones that I take off of Wyckoff, I always rely on the accumulation and distribution indicator. Okay. So let's look into this. So the accumulation and distribution indicator, or shortly known as AD, or accumulation and distribution line, ADL, is a cumulative volume-based momentum indicator that provides information regarding the money flow in a stock. The word accumulation refers to the level of buying and distribution refers to the level of selling. ADL was created by famed stock analyst Mark Chaikin in the early 1980s to measure the accumulation, that is buying pressure, versus distribution, that is selling pressure, of a stock over time. Now, this indicator was created by Mark Chaikin, so I don't want you to be confused with the different accumulation and distribution indicator that was created by Williams. And so the reason is, so the Mark Chaikin's indicator incorporates both price and volume in its calculation. I'm going to teach you what the calculation is, but Williams's indicator does not take into account volume. Now, for Wyckoff's theory to work, we need to rely on both price action and volume. So this is, I don't use the Williams's indicator because I want volume in the calculation, because it's going to give me the actual strength of buying and selling. All right. AD can reveal divergences between volume and money flow and actual price to primarily either affirm current trend or anticipate a future reversal. I.e., it will help us basically like any momentum indicator, it's going to help reveal convergence and divergence. And AD is also a leading indicator because it's trying to predict the future price move. It can help you trying to predict the future price move, unlike lagging indicators. Okay, well, let's get started. This is just a small brief intro of AD indicator. Now let's look at the calculation. Now, before I go over the calculation, I want to give a heads up. You don't actually need to know the calculation because your charting platform or charting software is going to do all that for you. But the reason I'm covering this is because we see a lot of people using like 10 or 20 indicators. You see all those, a lot of traders have those indicators, but none of them know what, when the line curve goes up, no one knows what's actually happening. They just say that, hey, the line's going up, I'm taking a trade, or the line's going down, I'm taking a short position. No one knows what that line going up actually means. I don't want my students to be like that. So since I'm teaching you this indicator, I want you to know what exactly means when the AD line goes up. I want you to know what that means. When the AD line goes down, I want you to know what that means, so that you know when something is going wrong with that indicator, you know that, hey, that's just an anomaly with that indicator. I'm not going to bother about that. Because listen, indicators are not perfect. Indicators have a lot of noise tied to it. Sometimes they make you false signals. And if you actually know how it's calculated, you'll be able to identify those false signals. Okay, so that's why I'm going to teach. I have 2 slides where I go over this calculation. Feel free to listen in. I hope that you listen in because it's very interesting and it'll actually help you confirm how this is working. Okay. All right, calculation of AD. AD indicator uses volume and price to assess whether a stock is being accumulated or distributed. The calculation of AD consists of 3 components. That is, it has 3 different parts to how that line is drawn. The first one is money flow multiplier, also known as MFM. The second one is money flow volume, also known as MFV. And the third one is the accumulation and distribution line, which is eventually the line that we're going to draw. Okay, so these are the components of the AD. Now let's take a look at the first one, money flow multiplier. So the money flow multiplier, MFM, also known as close location value, compares the closing price of a given period to the range over that period. And this can vary between -1 and 1. Take a look at this candlestick chart here. We've seen this in the last lesson as well. So this candlestick gives us information on what the open was, what the low was, what the close was, what the high was. Basically, it gives us the range of that candle as well. It gives us a lot of information. So the money flow multiplier, what it does is it's called as close location value. The reason why it is called that is because it compares the closing price of the asset here in this period, compares the closing price of that to the range over that period. So we compares the closing price with the high and low. Okay. And once it does that comparison, what's going to happen is if the price closes in the upper half of the high-low range, the money flow multiplier will rise closer to 1. So price in this example here, price started open here, hit this low and hit this high and eventually close near the highs. Okay. So in this case, since price closed near the highs of this high-low range, this big range, its value is going to rise closer to 1. So it's the range of this money flow multiplier is between -1 and 1. The higher the price closes, it's going to be closer to 1. Okay. The lower the price closes, it's going to be -1, the money flow multiplier, I mean. Okay, it's fairly straightforward. If you just think about it, we have a range of this candle, we have a high, we have a low. If the price closes near the high, its value is going to be closer to 1. If the price closes near the low, its value is going to be closer to -1. Okay. If price closes in the lower half, the money flow multiplier will rise closer to -1. And if the price closes in the middle of the high-low range, then the money flow multiplier value will be closer to 0. That makes sense, right? So -1 to 0 to 1. So if it's near the highs, it's closer to 1. If it's near the lows, it's closer to -1. If it's somewhere in the middle, it's closer to 0. Okay. So this is that formula for calculating the money flow multiplier. Once you know the OHLC, that is the open, high, low, and close of that period, assuming whatever period you're in, let's say in a 4-hour chart, each candle represents 4 hours. You just have to key in that information here, and you will be able to calculate the money flow multiplier value. And it's always going to be somewhere between -1 and 1. Okay. So that's the first one. Pretty easy, right? You guys got it, right? Second one, money flow volume. So the MFV, that is the money flow volume, is the product of the money flow multiplier, which is this number here that we just calculated, and the volume for that period. So let's say the volume for one 4-hour period is 1 million shares. Okay, so the MFV just can be calculated by multiplying the money flow multiplier and volume. That's it. So 1 million into, let's say this was 0.8. Just multiply that and that's your money flow volume. Okay, so that value here is your money flow volume. So the first formula here, we just got that MFM based on the price action. And the second money flow volume, we're adding volume into the mix, throwing volume into the mix and adding from multiplying that to get a different number. And that's number is called the money flow volume. The third one, now we're going to draw our ADL line. ADL can be drawn by summing up the MFV of current period and previous periods. ADL is equal to previous periods ADL plus current periods MFV. Now, before explaining the ADL, I just wanted to go over this example here. So take a look at this. So the open for this candle here is 306, low 305, high was 310, and close was 308. I basically just subbed in all those values and I got a value of 0.2 for the MFM, that is a money flow multiplier. Okay. Now I'm assuming that the volume for this period here is 10,000 shares to make calculations easier. So I just multiply 0.2 into 10,000. I get 2,000 as the MFV. Okay. Now let me actually take my drawing tool. So we always see our indicators like somewhere, we always see a line going like this, right? So let's assume that this is the AD line. Okay. So what's going to happen is AD is a running indicator. So meaning if let's say the current value AD value is 200,000. Okay. The previous period, that is the current value is 200,000. If the current MFV value, that is whatever we calculated for this new period, then let's say this is a 4-hour period. If we get a value of 2,000, what's going to happen is, since it's the positive number, this 200,000, this 2,000 is going to get added to 200,000. The new value is going to be 202,000. So currently this line ends at 200,000. We're going to see a small spike up, and the new value is going to be 202,000. Okay. So since the MFV is positive, we get a spike in that line, in that AD line. Now, if the MFV is negative, so if the price actually closed at 306 near the low of the day, what's going to happen is we're going to get a negative MFM value, that is minus 0.6. Now, if you multiply a negative number with that volume, you're going to get a negative MFV, that is minus 6,000 is the value you're getting. So after this 202,000, let's say we have a red day, so that is the price actually closed near the low, so so that's a weak candle. So what's going to happen is we're going to get a small pullback in that ADL line. So this line here is 196,000. Okay, hope you guys understand. So when the price actually, this indicator moves up, it shows you that there's good buying pressure and stock is actually going up. But when there's a pullback in that indicator, that just shows you that price closed near the low. There was the selling pressure was high, and it shows you that bears are in control. Okay, so that's how this indicator is calculated. I hope that this made sense. It's fairly straightforward once you understand the formula behind it. And the next slide, I'll teach you how to interpret all this. Okay, now that you know how it's calculated, I want you to know like what is the relevance behind this. Interpreting the MFM, MFV, and ADL. Remember when I went over Wyckoff's theory, what did I tell you guys? I told you that we want to measure the level of buying in the accumulation phase and the level of selling in the distribution phase. So basically, we want to know when in a ranging market structure, we want to know if smart money is accumulating shares or they're distributing shares. If they're accumulating shares, then you know that stock price is going to break out of this range and up to the upside, and you're going to make a profit off of that. If the stock is actually distributing in that ranging market structure, if you're able to identify distribution, then you know that the stock is going to fall and you can make money to the downside. Okay, this indicator is going to help you identify the level of buying pressure and selling pressure. So the first point here, let me actually get my marker. So the closer the money flow multiplier is to 1, the higher the buying pressure, since price closed near the high of the range. So this is one important thing when using this indicator is you need to look for longer time frames. So if you need to look for what I like is the 1 hour and 4 hour time frame. So I always select those charts, and basically what you're trying to read is if price is actually the accumulation indicator is trending higher and the money flow multiplier is closer to 1, that indicates that the higher the buying pressure. So since price closed near the high of that period, it shows that price actually dipped, bulls bought the dip, and price actually closed near the highs. That shows you that bulls are in control. They're trying to buy the dip every time they get in a ranging market structure. So when that, remember, volume is also taken into account in this calculation. So if you actually see a bigger spike in the ADL line, which I'll show you later on, that just shows you that the buying pressure is really strong. Okay. And similarly, if price closed near near -1, if the money flow multiplier value closes near -1, that just shows you that there's high selling pressure since price closed near the low of the range. So in this case, the price actually closed here. So it just shows you that they try to make the prices go up. But remember, I told you that one of the characteristic of distribution phase is that price fails to break the higher end of the range several times, and every time it tries to sell off, there'll be big volume. So in that case, it shows you that a strong selling pressure and price close near the low of the range. The MFM and volume for the period will determine how much the AD will rise or fall. So when you see the curve like having a big spike and the price is actually very green and there's good volume, you know exactly why you got that big spike, because price closed near the highs and you have big volume. Volume plays an important role in how much the AD spikes because it's a multiplier. Okay. But if price spikes and there's really low volume, you can see that the spike is not that much high because it's just a small spike and price actually like did not break out with huge volume. That's a weak uptrend. Okay, you guys learned about volume and correlation with price action in our last lesson. So hopefully this is not like a surprise. Okay, all right. Anyway, therefore ADL can be used to measure the strength of buying and selling, that is accumulation and distribution pressure. So there's good accumulation, then our curve is going to go up. And if there's good distribution, the curve is going to go down. I'll show you examples in the next slide. But these two measures can help us identify the strength of buying and strength of selling pressure in the market. Okay. So what are the uses of AD indicator? The AD indicator can provide two types of signals. One is trend confirmation and second is divergence. So typically we don't look for trend confirm. I don't use this indicator for trend confirmation because we can rely on price action for the trend confirmation. If the price is actually making higher highs, that's a bullish trend. Obviously, the indicator is also going to make the same kind of give you the same kind of signal. So when you see the accumulation and distribution line and the indicator rising and price is also rising, this means that the trend is up. So when price is going up, indicator is also going up. That means that the trend is confirmed. It's a bullish trend. Similarly, when the indicator shows a falling accumulation and distribution line, the curve is falling down and price is also making lower lows. That shows that the trend is bearish. Okay. Divergence is where we are going to make our money. Divergence occurs when the price and indicator move in opposite directions. So bullish divergence is if the securities price is in a downtrend, or in our case, we're more interested in sideways trends, while the accumulation and distribution line is in an uptrend, then the indicator shows that there may be buying pressure and the securities price may reverse to the upside. So when you see price is very flat, but the indicator just continues to keep going up, meaning indicating that strong buying pressure, that shows you that at some point we're going to break out of this range and price is going to rally. Similarly, for bearish divergence, if a securities price is in an uptrend, while the accumulation and distribution line is in a downtrend, the indicator shows that there's strong selling pressure or higher distribution. Okay, it's just the exact opposite. If the price is going up, but you can clearly see that the indicator is starting to fall, it shows you strong selling pressure. Then eventually we're going to break out of that distribution phase and start selling off. And the indicator will give you a warning signal when in both these cases, both in bullish divergence and bearish divergence cases as well. Now, remember I told you that no indicator is perfect. So I always use the AD indicator for swing trading, but AD has a weakness. And I use the OBV sometimes to overcome that weakness. So I'll give you a small overview of OBV, and in the next slide, I'll teach you I'll show you what the disadvantages of AD is and how OBV can help prevent that. Okay, overcome that. So the on balance volume indicator, OBV, is a momentum indicator that also uses volume and price changes to measure the strength of buying and selling forces. It's just like the AD, but its calculation is slightly different. Okay, so OBV signals can also be interpreted the same way as the AD. They provide trend confirmation and divergence. So the same thing that we discussed here, the OBV can also be read the same way. Both the AD and OBV indicator uses price and volume in their calculation, but they have different formulae. So we know how the money flow multiplier is calculated. It compares the closing price for a given period to the range over that period. MFM gives more weightage to where price closed in a period, thereby capturing the strength of buying and selling. So that's why this indicator is so beautiful. Based on where price closed in a period and the volume, it's going to tell us how strong the buying is and how strong the selling is. Not a lot of indicators can tell us that because this takes into account volume also in its calculation. That's why this indicator is very powerful. The OBV also gives you the way to measure the strength of buying and selling, but it does not take into account price to that extent like we want it to. So OBV provides a running total of an asset's trading volume and indicates whether this volume is flowing in or out of the given security. It compares the previous period's closing price with the current period's closing price. So what it does is, so basically we discussed how AD provides a running total of the MFV, right? So if the MFV is positive, the line gets another spike. If it's negative, it gets a fall. What OBV does is it just plots the trading volume. Okay. So what it's going to do is if the price, it's going to compare two different prices. So current period's price and the previous period's price. So if we're looking at the daily chart, it's going to compare the current period's trading prices and the previous period's trading prices. So the closing price of the current day is greater than the previous period's closing price, meaning if price actually went up, what is going to happen is the volume for the current day gets added to the running volume. Okay, so 200,000 is the running volume and today's volume is, let's say, 10,000. Price actually closed above yesterday's high, yesterday's close, then volume is going to get added to the running OBV running total. If price actually is the same as the previous day, then volume will not get added. If price actually closed below the yesterday's close, then volume is going to get subtracted. Okay, so what this is telling you is that it takes into account the closing price of the previous period. Okay, it compares the current period's closing price and the previous period's closing price. If price actually closed above that previous day's closing price, then we're going to see the volume added to this running total. If current period's closing is actually lower than the previous period's closing, volume is going to get subtracted. So there is a reason for all this madness. I'll tell you that in this slide here. So it is very important to understand how an indicator is calculated to know its advantages and shortcomings. AD shortcoming is that the money flow multiplier only takes into account the current period's closing price and range, but not the previous period's closing price. That is, price changes between periods. Remember, AD is just comparing the current period's value. If price closes near the highs, it's considering that as a strong buying pressure. If price is closing near the lows, it's considering as a strong selling pressure. Obviously, it's taking into account volume as well, but it is not really looking at previous day's closing price, meaning what happens between periods. So we're looking at a daily chart. All it's looking at is the current day's price. It's not taking into account what happened between today and yesterday. Okay. Now this is where the disadvantages come in. If a stock price gaps between periods, it won't be picked up by the ADL, causing the line and price to be out of sync. Let's take an example here. Let's say a stock gap down overnight by 10%. Okay. But on that day, so once the stock is down 10%, on that day, once the market opened, price actually gapped up a little. So if it was down 10%, it gapped up 3% on that day and closed near the upper end of the daily candle. Okay. So thereby, this will produce a positive ADL line because on that day, price actually closed near the high of the day. So it's going to produce a positive spike in the AD. But in reality, when you just look at price action, you can just see that the stock just gapped down 10%. There's no way that there's accumulation there. It's just the signal gives you a false, the indicator gives you a false signal in this case. Okay. In such cases, ADL will spike up while prices are continually declining on the longer time frame. So now you know why we went over the calculation, because it just looks at the current period and it does not take into account the previous period. And if there's a big gap down or gap up that's happening overnight after hours, that's not going to be picked up by the ADL at all. Okay, so that's why you needed to know all the calculation and everything, because ADL is very powerful and I really love the indicator, but this is one downside to that indicator. There's a big gap up or gap down overnight. It may not happen every day, and if you look at a longer time frame, everything is going to smooth out. But if you're looking at a shorter time frame and you're relying on to enter or exit a position, there may be a false signal produced here, and you as a trader need to be aware of it, why this is happening. Okay. Now, like any indicator, the shortcomings can be overcome by reading price action and by using other momentum indicator like the OBV for trend identification. Now, since OBV actually looks at the previous period's closing price, so both the indicators are diverging, that just tells you that, hey, maybe there's a divergence in both these indicators. Something's up. Let me actually take a closer look at the stock chart. And you will be able to see that, okay, there's a big gap down happen, like it happened yesterday. That's why these indicators are out of sync. Let me just wait for a couple of days and then see how things play out and then plan my trade entry or whatever. Okay, so that's the kind of thought process that has to go into your head when you see something, when you see the AD producing a false signal and AD and OBV are diverging. Okay. All right, now let's take a look at, now we went over all the theories. We know how everything works. We're all comfortable with the terms AD. Now I just want to go over some very good trade examples that we've exactly used the same strategies that we just discussed today. I want to go over it. And so this is number one, Shake Shack. It's a swing. This is something that we took earlier in the year. As you can see, so actually this is one of the trades that we took. We actually continued to bank off of Shake Shack that whole week. And we made like, I don't know, I made like 20,000 or something off of this one trade. So this is one of the screenshots. I can see it's a very high percentage return we gotten before the breakout. So this is something that I posted in the stock chat. I will start with the signals chat. I just told them how similar this is to the Beyond Meat breakout that we played a week earlier, and how the stock is accumulating in range. If you guys can screenshot it, you can read it, or if you're in the chat, you can go back to this day and read my analysis. Okay, so this is the play. I think I posted on Instagram as well, so you can check it out there as well. So going back to the stock chart, so I actually identified all the Wyckoff faces in this particular screenshot, so you can take a picture here. So there was a big decline. As you can clearly see, Shake Shack was declining. It was in a strong downtrend. People are selling off. Look at, they had a very poor earnings. They started to sell off. And once the sell off, there was a selling climax where the stocks started to find some support. And you can clearly see that there was this ranging market structure that was established. Okay, this happened. So I think I'm in the 4 hour time frame. So this was, so whatever you see here is the span of 2 or 3 months. That was the accumulation phase here for the stock. And the things that you can see here is every time the stock decided to like test this lower end of this range, it got bought back up. And every time it tested it here, this is the secondary test, it got bought back up. And every time it tried to break out of this range, it was shorted because it wasn't ready to break out yet, and was consolidating a little bit, and eventually it broke out of range. So that signifies the markup phase. So this green line here that you see, that's my AD indicator. Okay. So when I'm analyzing a stock chart, I like to bring the indicator with the price into the price span. So I'll show you my trading view in a while, but usually I have that in a separate pane. But when I'm analyzing like aftermarket or aftermarket close, I usually bring the indicator to my stock chart so that I can actually see how the indicator correlates with price action. And in this case, after the big decline, you can clearly see there was lower lows. Now you know how to read a trend, I hope. So this is lower lows and lower highs. And at some point we bottom and start creating higher highs here. So, okay, the indicator is creating higher highs, but stock is still trading in a range. And that clearly shows you that there's divergence here. And eventually we entered on 110. So this is where we timed it. So I know that eventually once we test this, there were too many green candles here. There was too many, there's a lot of volume coming in. And I knew that we were going to break out any day soon because the accumulation, strength of accumulation here is very strong. We're going to break this high any day soon. So we entered on 110 and we broke out of this range. I think a day or two later, I think we had one more fake out. So once we entered on 110, I think we had one more small pullback. We added more to our position there, average down, and then we eventually took off. So another important thing when trading options is when the market is trading sideways, the premiums are not going to be that expensive. It's going to be very cheap. Volatility is going to be down because the market's not pricing in a big move at all for the stock because it's been trading in range for several months. So when a big breakout like this happens, volatility is going to skyrocket, and your premiums are going to take a big bump up. So that's why you get all those large percentage returns, because you bought in when premiums were nothing and you accumulated positions, bought cheap contracts. And when the big breakout happens, look at this volume here, your premiums are going to skyrocket and you're going to make a lot of money. And over here, we actually were able to like make money off of this trade. We took profits at the top literally because we already got and bought the dip and we were able to profit. And this is where our first distribution phase happened. So this is on a 4 hour time frame. So each candle represents 4 hours. But you can see how many red candles were there. This based off of our momentum lecture, you can clearly see this as a weakening momentum because there's not a bull flag. Every time it tried to sell off, the volume didn't come in. We bought. It looks like smart money already started taking profits, and our indicator, look what it does. Every time it sells off, started creating lower lows and lower highs. It didn't exactly scream that. It didn't give you an higher high signal. It gave you a lower low signal. It told you that, it gave you a warning that, hey, I don't think smart money is interested in this anymore. Volume kind of died off. More red wall. Look at these red volume bars. More red volume than green volume. So it shows you that smart money is taking profit. This is where smart money took profit. They continued to accumulate shares here for the cheap. They took profit here. And eventually we went through a big pullback from 74 to 66. This is where the previous breakout level was. So there was another accumulation phase, meaning there's a secondary accumulation phase. So remember, there's not going to be just one accumulation phase or one distribution phase. There can be several accumulation and several distribution phase. If there's a secondary accumulation phase and the indicator shows confirmation, there's a chance that price is going to test the highs again. And in this case, we did get that signal. So once we had the lower high and lower low, we started to form another higher high here, but it was not that strong like this. See how strong this higher high and higher low was when the market was flat. Now the market's actually trying to trend up, but then we got a small higher high signal. So if you actually bought the dip here, you could have made profit off of this higher high this small rally here. But again, the indicator started to diverge again. We had a secondary distribution phase. This was where all the retail traders got back in again. They thought that the stock price continued to going to keep going up, and eventually we hit the top and they sold off big time after earnings. So clearly see smart money took profit. They got all the retail traders back in off the hype. They bought the top. Clearly they bought the top. They continued to accumulate here, and eventually we had another distribution phase, and boom, everything sold off again. Clearly see the lower risk, like over here. This was another example where the indicator gave you a warning that there was going to be a big sell-off before earnings. So so this was a very nice play. So we got in, we took profit here. We didn't touch the stock afterwards. We didn't participate in any of these moves. We played the move here and we made a lot of money here. We didn't play any of this after that. Okay, so this is trade number one. Hope you guys understood how the ranging market structure works and how the indicator was used to enter our position in harmony over here with the price before the breakout happened. Trade number two is Zoom. I think this was like my largest percentage return trade this year. So Zoom swing, again, the same Wyckoff play. I posted the trade 211. I think Zoom was just trading at 80 around that point. So now Zoom is, I don't know, was trading at 500 or something, 400 or something. So Zoom was an $80 stock back then, and I identified there's a big breakout going to happen soon. I said that there was a strong institutional accumulation in the stock. It was easily going to break 100 soon, and I accumulated shares multiple times, and we made profit off of this trade. This was a screenshot I took, but that the $100 contract that I bought was just $25 worth, and each contract was worth around $1,500 from $25. I don't have the screenshot because I took profit, but a lot of people actually held that position longer than I did, and they were able to make money. So $25 became $1,500 because of the range of this breakout. Okay, and let's take a look at this trade again. So Zoom was actually a very interesting stock. So Zoom from last year, it had a big sell-off, and then ever since it's been selling off in this big range here from 93 to 61. That's a $30 range for a stock, and we've been trading in this range for several times. The stock didn't show strong price action, but ever since earlier this year, look at the level of institutional accumulation. Every time it's sold off to this lows, I've never seen such strong accumulation in my life before. So much accumulation. This green line is our accumulation and distribution, and this orange line here is our OBV. So over here, you can clearly see the level of buying and selling here. Stock has been accumulating like crazy, and before even the breakout happened, like stock's already gone. The level of buying is like crazy, and our entry was somewhere around 211 here. So we missed our initial breakout of this range, but price was actually, we were lucky enough that price actually consolidated at the higher end of this our Wyckoff range, and we were able to enter our play on 211, and we held on to our position for a couple of I think 1 day or 2 days through this small pullback here. So once this pullback happened, we added more contracts, and eventually we broke out. And man, oh man, Zoom just in the next couple of days hit from $85, it went to $130. It just rallied in a couple of days, and the indicator was just this was one of the biggest return plays this year. And eventually there was some big ranges created here, and you can clearly see that the indicator over here already started to diverge from price action. So once this high was hit at this point here, indicator started to drop. And that just shows you that smart money was starting to take profit. And look at this sign here, this red bar here. So eventually we tried to retest. Once we tested the support, we tried to hit the high again, but the indicator never moved. So the indicator never actually caught up after this small sell-off. The price actually bounced, but the indicator never kept up. That just shows you that there was more downside coming, and we did sell off. So after we hit this low, we broke off. This was a distribution phase. We broke the low, and we actually tested this level of support here again. So once we test this level of support, you can clearly see the indicator also going up again, And once the indicator starting to create more higher highs, price actually eventually broke this resistance and created even more highs. And once we broke out this resistance, you can clearly see the indicators diverging again. And that shows you that there's another small sell-off coming. So you can clearly see how this indicators like giving you signals ahead of time, right? So the reason I had the OBV also here is because we were having a lot of gap ups and gap downs pre-market, like after us. So that's why I had the indicator here as well. So sometimes you can clearly see the AD is giving the right signal and the OBV is not giving the right signal. So in this case, it's still showing you that the OBV is giving you a buy signal, but the AD is giving you a sell signal. And when both of them are in the same direction, that's a good play. But sometimes they'll diverge, and you need to know exactly why they're diverging. And you know the formulas now. So if something's diverging, take a look at that price action much closely, and then you will know the answer to that question. Okay, so this is a nice trade. We combined basic Wyckoff theory. Once we broke out of this range, we have our indicator to give us confirmation. So this was a more recent trade. On July, we took SPCE, swing for the small account challenge that we're doing. That was a good, SPCE was trading at $17. We took a $17 call swing, small position, and made like 165%. It's a small account. I took profit on 7.9 on the next day. So this trade here again, I think I have two screenshots. So the reason for taking this trade is SPC after a long sell-off was consolidating in this small range here. But as we were approaching this level here, see how our indicator is starting to show higher highs already. And once we approach this level, there's a clear pennant forming, knew that we're going to break out of this range here, and we did. And the next day, see what happened. The same trade, once we broke out of this range, we just started to, we took profit the next day itself. So this is where we took profit. We entered the trade here, we took profit here. There was a small sell-off and we tested the breakout level again, but indicator just continues to keep going up, and we entered the trade again here. I think after we tested the support and price actually broke out of this range. And eventually, once we hit this high, you can clearly see we're showing lower lows here. Both the OBV and AD is giving the right signal. So if you actually shorted the stock here, we had a big sell-off. We didn't short the stock here because it was a bull market, so we didn't short. But you can clearly see what's happening. Gave you the signal. If you shorted over here, you would have made money. And there's another example here. This is the distribution phase. The buying volume dies down, the selling volume starts to pick up, and the indicators are diverging. And that's another cue for you to short sell or take profit off of this position. Okay, so this is another trade. This is INO swing trade that we took in July, and this was a nice trade. I made 89% in in my different Robinhood account. So INO moved 19% since entry. That's a 300% return on weekly contracts. So if you actually like enter the trade during when we took it. So INO here is a classic trade. INO was trading in range for several months again. Eventually, this was a classic. We broke out of this range and we actually sold off. We actually didn't trade the initial breakout that happened here. So I actually waited for the sell-off to happen, and we actually took the trade here. So once this sell-off like died down, the indicator actually started to give you higher highs, and even after the sell-off, there was still the strong buying pressure. So the indicator never actually kept up with price action. So that's the reason that we're just waiting for the simple, because this was just a big pullback, just waiting for this price action to break out of this small triangle here. We entered the our first trade here. We made bank off of this on July 7th. So if you look at the date here, July 6th was when we entered. So July 7th was when we had this big candle breakout. So we entered the trade on this small candle here. The next day we broke out. And then once we hit this resistance here, we started selling off. This was a small consolidation flag here. And the next day, this was that flag. And we eventually broke out of this flag as well. And we hit 27. And once we hit this level, clearly see all this price action here. This is that distribution phase. People thought that we're going to test this high again, the 34 high, but that didn't happen. Indicator started to move sideways and then started to show lower lows, and we started distributing. And you can see the sell-off. We actually tested the previous breakout level of $12 right in a couple of days. So if the stock took 1 week to get to this level, it went down even faster. Selling always accelerates because there's a lot of more fear and emotions involved. And indicator again predicted the right move ahead of time. Okay. Now, AMBA swing trade. So this was just recently at our last class, the previous batch of AMU. I went over this trade with them live. Uh, so, so we hit. So AMBA, we took two trades. First on August 24th, first second on August 27th. Price moved 18% since our entry, and AMBA again was trading in range. Eventually, we broke out of range. We hit this resistance and small consolidation. Indicator continued to move up. So we took our first trade here on 22nd, sorry, on 24th. And so once we took this trade, we broke out of this range, tested the resistance. We took profit somewhere around here itself. I didn't ride the whole trend, but some of them did. And we sold off, tested this previous resistance here. This green line is the 50 moving average. Clearly see price actually continuing to make higher highs. So we re-entered here again on 27th. Price actually was rallying, and eventually we broke out of this range as well. Hit our all-time high resistance here at 60, and then they sold off, distributed right on earnings. Now we're testing. We bounced off of this support here again, and now we're rallying. Now I think the price is going to test again. So which next week I'm actually watching AMBA again for a swing trade because we're showing higher highs here again. Despite this small pullback, this is just a bull flag. I'm expecting price to actually test 53 next week. Let's see what happens. Okay. I think that's all I have. So hope you guys enjoyed this lesson. It's a little complex strategy, but if you're taking positional plays, you need to understand the rationale behind it and actually keep looking for the stock, the right kind of stocks to trade. The key principle behind the Wyckoff trading, swing trading strategy is that you need to look for stocks that's recently sold off big, and you want to be able to identify accumulation and distribution. So if you're playing to the upside, you want either a big rally or a big decline, and then you need to keep watching the stock, set your alerts, set your ranges, and then keep watching the stock for at least several weeks. So once you know that something's happening, once your alert triggers and you measure the buying pressure and selling pressure, you can enter your stock chart. So this method requires actually putting in screen time ahead of time and studying a lot of stock charts and seeing what's happening in the stock and then taking positions and profiting off of those big moves. Okay, hope you guys enjoyed this lesson. Thank you. And now it's time for questions.